To understand Tesla today, we need to start with the shape of its financial journey. The clearest way to see Tesla's evolution is through scale. Revenue rose from $53.8 billion in 2021 to $81.5 billion in 2022, then to $96.8 billion in 2023 and $97.7 billion in 2024, before reaching $94.8 billion in fiscal 2025 and $97.9 billion on a trailing 12-month basis ending March 31st, 2026. That tells an important story. Tesla was once growing at a breathtaking pace with revenue growth of 70.7% in 2021 and 51.4% in 2022. But after that, growth slowed sharply to 18.8% in 2023, 1.0% in 2024, and then turned negative at minus 2.9% in 2025, before slightly recovering to 2.25% on a trailing basis. This is where things changed. Tesla stopped looking like a company in its early expansion phase and started looking like a company entering a more difficult stage. Scale without easy growth. That transition matters because businesses often look strongest right before investors realize the next phase will be harder than the last. Profitability tells the same story. Net income climbed from $5.5 billion in 2021 to $12.6 billion in 2022, and then to nearly $15.0 billion in 2023. But after that peak, it fell hard to $7.1 billion in 2024 and then to $3.8 billion in 2025, with trailing 12-month net income around $3.86 billion. So Tesla's past, based strictly on the data, is a story of two eras. The first era was rapid scaling in revenue, margins, and earnings. The second era is much more demanding, defending scale, rebuilding profitability, and proving that Tesla can be more than its core vehicle business. Today, Tesla's business is best understood in three pieces: automotive, energy and storage, and services and other. And this is the real reason why Tesla is still such an important company to study. The total business may look like it has slowed, but inside the company, the mix is changing. Let's start with automotive because that is still the biggest engine. For fiscal 2025, automotive revenue was $69.53 billion. That is still the dominant segment, but it was down 9.79% year over year, continuing a broader pattern of pressure across recent quarters. That decline matters because automotive has historically carried Tesla's identity, its scale, and most of its revenue base. When the biggest segment starts shrinking, the company needs other segments to grow faster just to keep overall revenue steady. And right now, that is exactly what seems to be happening. Tesla's energy and storage business is becoming much more important. In fiscal 2025, energy and storage revenue reached $12.77 billion, growing 26.62% year over year. Its gross margin was 29.77%, which was materially higher than automotive gross margin of 17.78%. That combination is powerful. Energy and storage is not just growing faster than automotive, it is also producing stronger segment-level gross margins. In other words, one of Tesla's smaller businesses is starting to look economically more attractive than the segment most people associate with the company. Then there is services and other. This segment generated $12.53 billion in fiscal 2025, up 18.95% year over year, with gross margin of 7.43%. That margin is much lower than the other two segments, but the steady growth shows Tesla is building a larger installed base ecosystem around its vehicles and infrastructure. So the present-day Tesla story is not simply car maker grows or slows. It is a portfolio story inside one company. Automotive is still the giant, but energy and storage is becoming the growth engine, while services expands the broader ecosystem. Now look at operating performance over time. Gross margin was 25.28% in 2021 and 25.60% in 2022, then fell to 18.25% in 2023. 17.86% in 2024, 3% in 2025, and 19.07% on a trailing basis. Operating margin followed the same pattern, dropping from 12.12% in 2021 and 16.76% in 2022 to just 4.59% in 2025 and 5.00% on a trailing basis. That decline explains why revenue alone is not enough. Tesla may still be a massive business by sales, but each dollar of revenue is producing less profit than it did during its strongest years. Profit margin fell from above 15% in 2022 and 2023 to just over 4% in 2025 and on a trailing basis. But here's the interesting part. Cash generation has not collapsed the way net income has. Free cash flow was $4.98 billion in 2021, climbed to $7.56 billion in 2022, fell to $4.36 billion in 2023, dipped to $3.58 billion in 2024, then recovered to $6.22 billion in 2025, and $7.00 billion on a trailing basis. That means Tesla is still producing real cash even in a weaker earnings period. And the balance sheet remains one of Tesla's biggest strengths. Cash and short-term investments stood at $44.74 billion on a trailing basis, while total debt was only $9.23 billion. That left Tesla with net cash of about $35.5 billion, a major financial cushion for a company investing heavily in future growth. This balance sheet strength matters more than people realize. A company with slowing margins but strong net cash has time. Time to invest, time to absorb pressure, and time to pivot its business mix without depending on borrowed money. Tesla is also still investing aggressively. Research and development expense rose from $2.59 billion in 2021 to $3.08 billion in 2022, $3.97 billion in 2023, $4.54 billion in 2024, $6.41 billion in 2025, and $6.95 billion on a trailing basis. That is a major long-term signal. Tesla is not managing the business purely for near-term margins. At the same time, selling, general, and administrative expense increased more gradually from $4.52 billion in 2021 to $5.83 billion in 2025 and $6.42 billion on a trailing basis. So while overhead is rising, R&D is growing faster. That suggests Tesla continues to prioritize product, technology, and platform development over simply protecting current earnings. Tesla's delivery data also helps explain the present. Total vehicles delivered were 1.79 million in 2024, 1.74 million in the March 2025 period, 1.68 million in June 2025, 1.71 million in September 2025, 1.64 million in December 2025, and 1.66 million on the March 2026 trailing figure. That points to a business that has reached very large scale, but is no longer showing the kind of relentless delivery expansion that once defined the company. Most of those deliveries are still concentrated in Model 3 and Model Y. That category represented about 1.60 million units in late 2025, compared with roughly 59,000 for Model S, Model X, and Cybertruck combined. That means Tesla's volume base remains highly concentrated in its mass market lineup, and pricing pressure is visible in the model pricing data. For example, Model Y base MSRP declined from $65,990 in 2022 to $34,490 in March 2024, while Model 3 dropped from $46,990 to $33,990 over the same window. Lower prices may help demand, but they also create pressure on per-vehicle profitability. You can see that pressure clearly in per-vehicle returns. Revenue per vehicle was $45.70 thousand in December 2024 and $49.65 thousand in September 2025, reaching $50.37 thousand in December 2025. Gross profit per vehicle, however, was $6.88 thousand in December 2024, rose to $8.01 thousand in September 2025, and $9.35 thousand in December 2025, still showing how sensitive Tesla's economics are to pricing and cost discipline. Now let's talk about Tesla's moat, because the company's long-term case depends on whether it has durable advantages or just a famous brand. Based on your data, Tesla's moat looks real, but it is also evolving. It is no longer only about selling EVs first. The first advantage is scale. Tesla is operating near the $100 billion revenue level, delivering around 1.6 to 1.8 million vehicles, and supporting that business with a growing global footprint of stores, service locations, and supercharger stations. By late 2025, Tesla had about 1.55 thousand stores and service locations and 8.18 thousand supercharger stations. That matters because scale creates efficiency, customer convenience, and infrastructure depth all at once. A smaller EV competitor may build a good car, but matching a broad sales, service, and charging network is much harder. And this is the real reason why Tesla still has strategic weight beyond pure unit sales. The second advantage is business diversification inside the same ecosystem. Automotive may be slowing, but energy and storage is growing much faster and at better gross margins. That gives Tesla something many auto companies do not have: a second large growth platform that is tied to the same broader electrification trend. The third advantage is financial resilience. Tesla has over $44 billion in cash and short-term investments, modest debt, and positive free cash flow. That combination gives the company flexibility to keep investing even when profitability is under pressure. The fourth advantage is operating reinvestment. R&D has grown significantly, reaching nearly $7 billion on a trailing basis. A company willing and able to fund innovation internally has more room to adapt than one forced to cut back when conditions get tougher. And there is one more subtle moat here: installed base momentum. Services and other revenue keeps growing, which suggests Tesla is building recurring economic activity around the vehicles already on the road. Even though segment margins there are lower, the ecosystem itself can deepen customer relationships over time. So Tesla's moat is not one thing. It is a layered moat: manufacturing scale, infrastructure reach, balance sheet strength, a growing energy platform, and an ecosystem that goes beyond the initial vehicle sale. That does not make Tesla unbeatable, but it does make it harder to challenge than a simple car company label would suggest. Risks. Of course, none of this works without acknowledging the risks. And Tesla's risks are very real because the data already shows where the pressure points are. The biggest risk is margin compression. Revenue has stayed large, but profitability has fallen dramatically from peak levels. Gross margin, operating margin, profit margin, EPS, and ROE have all moved down sharply from 2022 and 2023 highs. That means Tesla's challenge is not just selling more, it is earning more from what it sells. If pricing remains under pressure or costs rise faster than efficiency improves, revenue growth alone may not restore the economics investors once expected. The second risk is automotive concentration. Even with growth in energy and services, automotive still represents the majority of revenue at $69.53 billion in fiscal 2025. If the auto segment weakens faster than the other businesses expand, Tesla's total results will still feel that pressure. The third risk is slower delivery momentum. Recent trailing delivery figures show that Tesla is no longer in the phase of explosive annual unit growth. When a company reaches scale, even small slowdowns can have an outsized impact on market expectations and operating leverage. The fourth risk is return deterioration. ROE fell from 32.49% in 2022 and 27.35% in 2023 to 10.42% in 2024, 4.93% in 2025, and 4.68% on a current basis. ROA and ROIC show the same broad decline, which suggests Tesla is generating lower returns on a much larger capital base than before. That matters because great businesses usually need one of two things to stay exceptional: strong growth or strong returns. Tesla's recent data shows slower growth and lower returns at the same time. That does not break the company, but it raises the difficulty level for the next phase. Another risk is dilution. Shares outstanding continue to rise over time, with share change around 0.86% in 2025 and 0.76% on a trailing basis. That is not catastrophic, but it does mean per-share gains do not always move as fast as company-level gains. And finally, there is execution risk. Tesla is clearly spending heavily on R&D and expanding energy and infrastructure capacity. If those investments do not translate into stronger revenue mix, margin recovery, or better returns over time, then today's spending may look less like strategic investment and more like expensive maintenance. Now comes the most important question. What could Tesla look like over the next 5 to 10 years if we stay grounded? The most logical answer is that Tesla's future will probably be defined less by pure vehicle volume growth and more by business mix. In other words, the story may shift from how many cars can Tesla deliver to what kind of company is Tesla becoming. If automotive remains a huge but slower growing base business, then energy and storage may become the segment that changes the narrative. That business already generated $12.77 billion in 2025 revenue, grew 26.62%, and earned gross margins close to 30%. If that trajectory continues, energy and storage could become a much bigger share of Tesla's economics over time. And that would matter because a company with two major platforms is different from a company with one giant segment and a few side businesses. A broader mix can make revenue more resilient, can improve margin quality, and can reduce dependence on vehicle pricing cycles. That is one of the most important long-term takeaways from the data you shared. There is also a reasonable long-term case for services becoming more meaningful. The segment is already over $12.5 billion in annual revenue and continues to grow at a double-digit pace. Even with lower margins today, a larger installed base could gradually support a bigger ecosystem around the core product. Meanwhile, Tesla's financial position gives it room to keep shaping that future. A net cash position above $35 billion, strong liquidity ratios, and ongoing free cash flow give the company optionality. It can keep investing, expand capacity, and absorb volatility without the same financial pressure many capital-intensive companies face. But the future will likely not look like the past. The years of 50% to 70% revenue growth are already behind the numbers. The next chapter probably depends on whether Tesla can become more profitable as a diversified electrification platform, not simply a larger EV manufacturer. So the best long-term interpretation is balanced. Tesla still has scale, cash, infrastructure, and a fast-growing energy segment, but it also has slower automotive momentum, weaker returns, and a clear need to prove that its next era can be more efficient than its current one.